So in the US, they are passing the big, beautiful bill, which is actually, it sounds like a nickname for it. It's actually what it's called. And it is going to add an enormous amount to the US deficit, which has got people on both sides of politics rather upset because the number is quite large. It would add $500 billion to US debt, or the US deficit. Let's get our words right. Next year, rising to $700 billion by 2034. So that's added to the deficit. Now, I know, Steve, we say, well, we shouldn't get too hung up on this figure. But maybe we should, if it's such a large number, shouldn't we?
No, it's just going to the wrong people. I mean, this is I think it's pretty obvious that the Trump presidency is got more to do with acquiring assets than it has with managing the country. And did you see he's released a new form of cologne in the last couple of days?
No.
You haven't seen that? 47 and 49. Get some while stocks last.
So you
Male
now
and
too
female.
can smell like Donald Trump.
You can smell like Donald Trump, which I'm told is not a particularly pleasant experience when you get up
That might
close.
actually be his downfall, perhaps.
Yeah, I don't think using that particular aroma as the contents of though the way things are going, I wouldn't be the least bit surprised if that actually happened. But yeah, so the deficit itself, it's creation of fiat money, and one reason the American economy is relatively speaking booming at the moment is because there's been a lot of fiat money creation, starting with the COVID. The funding that had to occur with COVID, otherwise we would have had massive bankruptcies across the board. Without government money coming in at that stage, capacity to pay private debt would have collapsed. Capacity to pay mortgages would have collapsed, and we would have had a chain reaction of bankruptcies that would have been absolutely devastating. It wasn't done
The problem is
properly.
right now we're trying to pay all of that back. That's the problem.
No, we're not, and that's the mistake. We're thinking we should pay it back. That's the mistake, okay? What you get is when the economy is pumping a large amount of fiat money in, when a government's spending more than it's taking back in taxation, it creates money, and that circulates in the economy. The trouble is with this bill that it's just cutting off the taxes for Trump and his wealthy mates and cutting off the services at the other end for the poor. And so you've got a horrible combination.
Yeah, and yet they would say, of course, the argument that was used the first time around when the 2017 tax cuts were introduced. It was the whole Laffer curve argument, wasn't it?
Yeah,
that if
it's actually, I love his name. He's obviously laughable.
Yeah, but absolutely, it's a great name for it, isn't it? But for those who are not across it, the argument here was that if we lower the taxes for wealthy people in particular, then they're going to use that money to increase employment and productivity within the economy. That means more people will be in jobs, therefore they'll be paying tax. So actually, the idea of we cut taxes will actually increase our tax revenues, which will make the government richer, but also the economy richer. That was the great white hope. And it did a bit of that. It didn't help the government at all. It did actually help the economy a little bit if I look at some of the numbers. So those tax cuts, the top rate, took the top rate down from 39.6, from 39.6 down to 37. Not a big one, but the big one was corporate tax, which went from 35% to 21%. But I mean, it's not actually. There's nothing. What is surprising is there wasn't anything too astonishing in all of those. Everyone says, well, it's helping the rich and not helping the poor. It certainly wasn't helping the poor. It was helping the rich a little bit, but that corporate tax rate from 35 to 21. The UK corporate tax, depending on how much corporate tax you're paying, is 19 or 25. Around the world, it's much of a muchness, actually. So I think we get a bit hung up about it helping the rich more than the poor. The issue is, though, there is this any idea of trickle-down didn't happen. The second part of that, well, let's tax the rich less. So they did that. It did help the economy grow a little bit. So real GDP in 2018, it went from 2.4% in 2017 to 2.9% in 2018. Tax revenues did increase a little bit, but a lot of that was a rise in payroll taxes because more people were employed. So it did work, but only for a year. And so and then of course we had the pandemic, so it's difficult to tell how. But I mean, it was already starting to. It was almost like a 1 year injection. But it didn't have any longevity to it. And now it's going to be there forever with this new bill.
Yeah, and the expression trickle down, reworked it. Just put an extra space inside there and speak it with a French accent. Trickle-down. Okay? Because what it does is it tricks people at the bottom of the. You didn't get that one, eh? Trickle-down.
No, I got it. Don't worry.
It's
No,
dreadful.
we don't need to
I
label
agree
it.
it's dreadful, but nonetheless, it's a simple way to change the meaning with one. Just put a space inside there. And what the problem with trickle-down is that the wealthy spend far less than the poor do. Proportionately, they spend far more, of course, per person. But when you're wealthy, you're not spending a large amount of your assets every day. When you're poor, you are spending a large amount of your assets every day. So if you want to add to the turnover in the economy, the best thing is to give it to the poor. And what will they'll do? They'll go shopping at the local Walmart or whatever else, and they'll buy stuff, and it ends up being profits for capitalists. This is the argument that Koleski made just by doing the two-sided accounting of the expenditure versus the income definitions of GDP, and showed that when you look at what take taxation out of the equation as part of the way that Koleski worked out the logic, government spending is spent on corporations. So the money turns up in the firm sector.
But it's such an unfashionable way. What you're talking about there, Steve, is demand-driven growth. I mean, you must know. It's all supply-driven these days. It's the companies grow, they employ people, therefore people buy stuff. Not quite sure during that period when they make the stuff before they've employed the people and paid wages, who's actually buying the stuff that they're making. But apart from that,
the whole focus on eliminating the deficit shows the inability of people at the top of the political system to understand how money is created. And that's the fault of economists who teach garbage. The politicians, people think the politicians are in control and know what they're doing. I've met enough of them over the years to know they have no bloody idea of what's going on, and they're regurgitating what they learn if they do a year of economics, which most of them do at some stage in their degrees. The PPE course in the UK, Economics 101, part of a liberal arts degree in the States, or they do a law degree, they'll do a bit of economics, and so they swallow this garbage, and then that means they don't understand the monetary system. But economists themselves don't understand it. So,
we talked about that a lot on this podcast.
Yeah, we do. We have to, unfortunately.
Every week we talk about it. But this week, actually, I want to focus on the role of bonds in all of this.
Okay. Yeah.
Because one of the points is, if you've got this extra deficit spending, the way that is traditionally dealt with, the government will issue more bonds. So if we have an extra 500 billion in government spending next year as a result of this bill, that is 500 billion added to the deficit. The deficit is about 2 trillion. So we would actually be issuing basically 25% more bonds. So when I said, is that a large amount? I'm just wondering, is there a point at which you start to think, well, actually, some of these shifts are too large? 25% increase in the government issue of bonds seems like a lot.
Yeah, it's a lot, and it'll be absorbed in a matter of milliseconds by the bond market. And this is, again, some people not understanding, because they think that the government sells bonds to the households. And this is the mythology, again, if you read neoclassical textbooks, as I haven't unfortunately done. What you find is they believe that the government and the firm sector are both finances by households, which save, and then banks are intermediaries and enable the firms and banks to borrow money from the households. It's not actually the banks doing the lending. That's garbage. It is not just. It's not even a good as-if model. It completely misunderstands the structure. So what actually happens when the government issues bonds is that they're sold on what's called the primary market or the gilt market and so on, and they're purchased to actually be a part of that market. You've got to have an account at the central bank. And then what you do when the auction goes through, you pay for what you're buying by transferring from your account to the treasury account, also at the central bank. So unless you're in the central bank, you're not part of the primary auction. And then the question is there enough money in the bank accounts of private banks and primary dealers at the central bank to pay for those bond issues? Now, if you go back before the global financial crisis, the answer was no. Okay, there weren't enough reserves there because banks didn't make any money out of reserves, and they'd used previous reserves to buy bonds, so they'd converted the reserves they had to bonds. So you only had a trivial amount of money actually existing in the reserve accounts. All that was in bonds. Now, what that meant was that let's say that I think there are roughly 50 weeks in a year, aren't there? roughly speaking.
I've got 52 based on
Oh,
my
damn.
extensive
Okay. Well, look,
research.
I'll round it out. So if government debt's 100% of GDP and it has 50 bond auctions a year, then that means, and then if you look at the deficit, if that's let's say 10% of GDP, which is far more than it is, okay, then 10%, when you're looking at, if you're going to issue 10% of GDP worth of bonds over a year, then you're going to be you're only selling 1/50th of that, roughly 0.2% of GDP worth of bonds at every auction. If they're going, imagine them going at the same. They varied radically over time, but the average
And
levels.
vary by duration, of course, of the bonds that are being issued as well.
There's a whole lot of mathematics that the people issuing the bonds make about the yield curves and demand for different bonds and so on and so forth. Okay, but each auction is going to be about 0.2% of GDP if you're running a 10% of GDP deficit. Now, if you don't have enough money, reserves, pardon me, there's not money, it's funds. If there aren't enough funds in the reserve accounts of banks, then the central bank undertakes what they call open market operations, OMO. Okay? With open market operations, they buy and sell bonds with the banks and with non-bank financial institutions that also own bonds all the time. It's an active part of trading. So if there's not enough reserves existing, they buy the equivalent of 0.2% of the outstanding bonds that currently exist. And if we say currently we've got a government debt of 100% of GDP, that means there's in America, $25 trillion worth of bonds outstanding. They buy 0.2% of that, and they then put funds in the reserve accounts of the institutions that are able to buy in the primary auction. And then at that point, back before we had the huge growth in reserves through quantitative easing, pardon me, after the global financial crisis, that would increase the amount of reserves available to be equivalent to enough to buy the bonds.
Yeah.
Okay, so then they'd buy the bonds. And
so putting liquidity into the banking system so that it all functions.
It's part of the reason that the Federal Reserve exists in the first place, is to manage things so that there's always enough funds to buy the bonds that are being issued.
Okay, so that's buying US bonds, right? But you can buy bonds anywhere else in the world, and there is this concern now. Based on what you're saying, I understand you'd say, well, why would there be any risk? Because they will always, the US is not going to default. You're always going to get your money back on US bonds. And yet it does seem like there is this risk factor now being put against US bonds.
I've never seen it before either. I've never seen anybody say there's going to be a potential government bank default, except virtually every week for the last 50 years. Okay.
But money is certainly flowing out of the US. And it's some of it is corporate bonds, so that's understandable. They are at risk, but also it's government bonds. So we're seeing yields rising, and it's a lot of people are saying, and the US dollar falling. And people are saying, a lot of people are saying that is because there's this risk factor that is being put against US bonds, and yet they shouldn't be, because you will always get your money back.
Yeah, if you look at currency markets aren't my specialty, so I might be talking through my hat, metaphorically speaking, to some extent here. But I would imagine that a lot of the reason people are pulling out is watching the chaos in America. And the normal story, whenever there's a crisis, and this is something which, what's his name, Steve Moran, the chief economist advisor for Trump, at least he was last time I checked, he argued that when the currency markets were perverse, in that when there was something which was threatening to the American economy, that would drive up the value of bonds, because people would go into buying American bonds as a safe haven. They'd see now, I think the safe haven effect, under Trump, ain't nothing safe about the United States right now. So I can imagine that's a major reason why people are trading the dollar down on global markets, and therefore they're buying, corporate bonds issued by Europe rather than those issued by America.
And why we're seeing yields rising on government bonds as well. So, just so everyone's on the same page, the yields and the price of bonds are opposite to each other. They work opposite to each other. So the example would be, if I was to borrow $100 off you, you issue a bond, and you say, well, I'm going to pay you back 10% a year, but actually I'm going to set that now, so I'm going to pay you $10 back per year. So I'm okay with that. I've got my 10%. But if I sell the bonds to someone else, I say, oh, these are worth quite a bit now. Steve Keen never defaults. Yeah, right. I'm going to sell the 100 for $200, but the new owner is only getting $10 per year. So actually, his yield is now not 10%.
5%. Yeah,
it's only 5% now.
Yeah.
So from a bond buyer, when you see the prices going down and the yields going up, that's a really good time for you to buy into buying those bonds. But for the person issuing those bonds, it's a really bad time, isn't it? Because they're still having to pay out that higher yield and they're getting less money. And that's what's happening in the US now, that the government is having to pay high yields when it auctions these bonds out, and it's getting lower prices as a result of all of that.
I mean, it's the short end they have almost complete control over. What they didn't have control over is the long end. But even when they issue they'll be issuing 30-year bonds as part of the whole selling. They'll be selling 1 and 5 and 10-year bonds as well, but there'll be some 30 years in the mix. And they pretty much control the sale at the primary auction by, again, that same mechanism. If there isn't demand there, they just create the funds by buying existing bonds off the financial institutions. They've got to go back and use those funds to buy bonds again. So they've got a fairly strong control over what will be sold in the primary auction. What you can't control is the secondary market. And then in the secondary market, that's where you're getting the buying and selling of bonds on a grand scale. And people are using the fact that an increase in interest rates reduces the price of bonds and vice versa to make capital gains, or try to make capital gains on the trading.
But then that drives the market, doesn't it? So so say, for example, let's look at 30-year treasuries. They've gone from, back in July 2022, the yield was about 3%. Now it's nudging 5%. So if the government issued more debt right now, they'd have to go with the market, wouldn't they? Because no one's going to buy 30-year treasuries if it's only
they can set whatever rate they like. Because
but who's going to buy? Who's going to buy them if somebody else can sell what they've got and say, right, I'll give you a 5% yield? They can't come along and say, no, buy from us, we'll give you a 2% yield.
Well, the thing is, the banks can't use, they can't, in the primary auction, they're using the funds they've got at the central bank. Okay?
Yeah.
So you can't use them for anything else. Now, at the moment, one of the encouragements not to buy the bond issues are that you're getting paid interest on reserves. And this is something, Ted Cruz discovered that a couple of weeks ago, and I made a video about it, saying he's actually right. The whole issuing of interest on reserves is only because huge levels of reserves were created by quantitative easing, and the banks can't get rid of them. They dribble out slowly through international transactions and various things I'm covering, and some work I'm doing on a new paper on the monetary dynamics of trade. But fundamentally, they're stuck with those high levels of reserves. So now the government, the central bank, decided to pay interest on them. So there's an interest rate differential between the reserves and the bonds, but the bonds are still offering a higher rate. So when you get to even if you can buy the bonds more cheaply outside, there's an enormous amount of buying power with the Fed in terms of how it can set those rates. It controls the short rates much more easily than the long, because the long are much more volatile. So as you're saying, if the market rate, is above or below the Fed's rate, it's very hard for them to control the long rate. But they've got the capacity. And one of the classic sayings in the bond market is "don't fight the Fed." And the reason that makes sense is because the Fed could literally, if it wanted to, if I wanted to shut all the squealing up about government debt, and I was head of the Federal Reserve, I'd buy all the outstanding bonds tomorrow. Okay, okay, and then suddenly, okay, goodbye bond market. I've got all the bonds. And I can simply say, the bonds are, you kind of got $45 trillion worth of bonds out there. I'll pay you $50 trillion for them. You want that deal? Okay, all right. So I'm going to put $50 trillion in the reserve accounts of the banks, so they make a capital gain. That's $45 trillion worth of bonds. They sold them for 50. They come out ahead. The central bank puts $50 trillion worth of bonds. It records them as that on its asset side, and $50 trillion as liabilities on the reserve side, because it's now increased outstanding reserves by $50 trillion. And then suddenly banks would lose income at the moment, which runs at about the level of 5 or 6% of GDP. All those bonds will be owned by the central bank. Now, the central bank either doesn't pay interest on the bonds or
Yeah.
it transfers the interest to the treasury.
So
So
you
all
get
this, it's a
collapse in
shadow
the
play and
banking,
it pisses me off beyond belief.
get a collapse in the banking sector and no liquidity in the banking sector.
Yeah, so,
Yeah.
oh shit, we want you to issue more bonds. We want a deficit. Where's the deficit? It's not big enough. I mean,
Yeah.
if you know, it's like a bunch of spoiled children, and you take away the toy that's causing the fight, and then the kids are going to be pleading with you rather than fighting with each other.
'Cause they
That
have
sort
no
of thing.
toy
Not that
to
I've
play with.
not that I've had
Yeah.
to try that, but I'm sure you've had a few experiences that way.
Yeah, yeah, of course. So, all right, look, we're at the halfway point. When we come back, let's look at the figure then. About I want to talk about the figure that is supposedly being added to the government's debt that is being paid for by future generations, of course. Let's look at all of that when we come back on the Debunking Economics podcast. So, Steve, we finished part one with you talking about how it would be a nonsense if the government was to issue bonds and they weren't held by commercial banks or on the secondary market. If they were all bought up by the Fed, then you'd have real liquidity problems in the banking sector. And more to the point, the banking sector would probably collapse because they're not making all the interest that they're making from those bonds. But that interest thing is an interesting thing, isn't it? Because the government is the government is paying.
Interest is interesting. Yeah.
Interest is interesting. Well, it is to us anyway. The government is paying over $1 trillion each year. I think quite a bit more than that. And then this new bill is going to add so much more because of this increase in government spending. So all that extra money, all those extra interest payments. I mean, this is where the detractors from the bill are saying, right, in debt, we are already paying more in interest payments than we are paying to fund the defence force or more than we are putting into Medicare. So we are going to have to cut back on government spending because we've got all of these interest payments to make.
Nonsense again.
But again, for the same arguments that we've heard before,
Yeah,
it's actually those.
the government creates the money that it spends, and it is, and this whole, and this is the fallacy which comes out of neoclassical economics and its bullshit model of loanable funds, because if you have the model of loanable funds, and I've done this in Ravel simulations, and I'll keep on doing it on YouTube videos as well. If you have the loanable funds model, then creating debt doesn't create money. So if you borrow money off the household sector, which is what the textbooks pretend that government does when it sells bonds, then that increases the government debt, but it doesn't increase the money supply and it doesn't change GDP. And therefore you get this, and then if you issue bonds to cover interest on bonds, you get an exponential takeoff in interest payments, and pretty shortly you're paying 100% of GDP in interest, which is what is scaring the pants off poor little Elon Musk. I think I might make a video called An Absence of Photons, because he's making the same mistake he used to make when he was afraid of the dark as a young child. But what's actually going on is when the central bank pays interest on reserves, in that case, which they're doing at the moment because they've got to pay a high rate on reserves as well as a high rate on bonds, they're doing it by simply crediting that amount of funds to the reserve account, saying here's interest on outstanding reserves, and they go into negative financial equity, which they can do. They're the only bank which can survive with negative financial equity. Private banks can't do that. When you get Treasury paying interest on bonds, it creates the money in exactly the same way it creates the money to finance its spending in excess of taxation. So it is just it's not a case we're going to go bankrupt because we can't afford to repay the interest or pay the interest and repay the debt. You're paying too much money to the finance sector, and if you want to reduce it, cut interest rates from 5% to 2%, which is something Trump is arguing for, and for once I agree with him. You're giving too much money to the finance sector, but you could literally reduce it virtually overnight by saying, okay, we're going to drop the rates, which currently 4.5% is the Federal Reserve's policy rate. Drop it to 2%, and that'll cut you. Rather than spending as much on defence, you'll be spending half as much on defence.
Right,
they're both wastes of money, okay, but you can control them.
Yeah.
Not the defence spending, that's out of control.
But I mean, but obviously defence spending will make sure that we all die in a nuclear war before we have to worry about global warming.
Oh, that'll be such a relief,
Yeah, exactly.
Freezing to death rather than melting to death, yeah.
Money well spent. Yeah. So, but I mean, it's the criticism often given, though, because you could say, well, okay, let's not stick it on the books. All of these interest payments, let's not stick it on the books because that's a distraction. Actually, even better, let's get the central bank, let's get the Fed just to pay that interest, to give, to basically create that money for the government to pay off the interest. But that's the criticism of, and that's talked about, hasn't it been, in lots of places around the world. But the criticism of that is it's monetizing the debt. What it's actually doing is the central bank is stepping in. It's no longer independent because it's stepping in to help the government, and the government doesn't have the need to control how much it spends if the Fed always steps in and will pay those interest payments. That's one of the big criticisms of it.
Yeah, and that's another one which is off with the fairies because again, the Treasury the Treasury itself creates the money. The one thing that the Fed does is it holds the bank account through which the Treasury spends, and if so it's all the Treasury decisions about spending more than it gets back in taxation. A large part of which is not decisions, of course. There are so many things that are locked in government spending that fluctuations in the economy drive the level of government deficit, and rather than the other way around, until they decide to take policy action, and then the deficit dominates the economy. But it's the Fed literally, in terms of paying interest on bonds, plays no role whatsoever, apart from making sure there's enough reserves available to buy all the bonds that are on sale in each of the weekly auctions. So the Fed is simply being a conduit there. And the one thing it does control, the Fed sets the rate that bonds, the interest rate on bonds. So that's something which which the Fed has control over, and that's where they're amateurs because, again, they believe they're controlling the rate of inflation by controlling the rate of interest. When you do the empirical work, which people like Isabella Weber and Blair Fix have done far better than me, when you look at their work, it's not the level of money that controls rate of change of prices. It tends to work in the opposite direction. Changes in prices cause changes in money through the credit mechanism. And what the government's doing comes in as far less important and reactionary in nature rather than initiating inflation.
Yeah, well, we didn't. So I might have got the wrong end of this because I didn't read the article. I just saw the headline. But Andrew Bailey from the Bank of England saying there's not enough debt for the Bank of England to be effective. Basically, that the interest rates. I mean, the whole idea behind interest rates is to try and control how much you spend. So if you've got debt, like you've got a mortgage, and the mortgage is high, then you've got less money to spend. Therefore, that's going to control inflation. That's the way they think, of course. And he's saying, well, there's not enough debt. So if we had private debt, he's talking about. So if they had no
bloody hell, that's just what we need.
Because I thought private debt was quite high in the UK.
It is quite high. It's a lot higher than government debt. It's about, I haven't looked at the numbers recently, but it's about 1.7 times GDP versus government debt. And he's saying it's not high enough.
Because the philosophy
Christ.
is that the interest rates will control how much you have available in the household for you to spend. And if you've got a lot of debt, interest rates go up. You've got bigger debt repayments for the household. Therefore, you've got less money to spend on stuff that's not, that will push up inflation. So we've got to get government. We've got to get private debt up. I think he says. Anyway, I didn't read the article in full, but just
Send
the
it
point.
to me later because I might have a go at that on a YouTube video.
Yeah, if I've got.
That time I attacked the UK rather than an American for a change.
But the whole thing though about interest rates is interesting, isn't it? Because we talked about how there's different durations. There's there's 2 years, 10 years, there's 30 years. There's talk about 50. There's even been talk about 100-year bonds from Donald Trump in the Mar-a-Lago Accord, which we'll come to in a moment. But if how much you talked about the Fed's got less control over the 30 years. It's got the market drives that more. But even at the short end, so if the Fed was to say, is part of the reason that people are buying US bonds right now because the yields are good. So let me see if I can find the numbers quickly. So around 4.3% for the US, 3.3% for Canada, 4.5% for the UK. But, in lots of Europe, it's a lot less than that. So actually, they are higher in the United States. So those people are going, well, okay, where do I buy? Yeah, the US is a bit dodgy as a country right now, but look, they're paying good yields on bonds, so I'll keep buying treasuries. If they drop them, say they did bring them down 2 percentage points, not even points, 2 full percentages, is what Donald Trump wants to bring it down to. So if it was sitting around 2.5% rather than close to 4.5%, people would be going, well, why do I want to be in the US because I can get better yields elsewhere?
Again, because it's not your bank account you're buying. Individuals and non-bank financial institutions buy out of their bank account, so they are more liable to make those sorts of decisions. But the primary dealers, and particularly the banks that are involved in that primary auction, they've got no other use they can make of reserves. And this goes back. This is why the Glass-Steagall Act came into being, because during the 1920s, banks could buy shares, which of course they did. I don't know whether they used margin debt to buy them, but everybody else was using margin debt. But by borrowing money, by buying shares, they drove up share prices. And then when share prices fell 10% in one day, on Black Tuesday, a lot of the banks were instantly bankrupt because their assets had fallen in value of the order of 5%. Let's say half their money was in shares and half in loans. They have 5% fall in their equity, no change in their liabilities, they're bankrupt. So the idea of Glass-Steagall is to disallow deposit-taking banks, which are the only banks that can create money, disallow them from holding anything other than reserves, which are created by government spending, loans, which they create by lending to individuals, and bonds, which they buy off the treasury in these auctions. So if they have the reserves and there's a higher yield on bonds, and frankly, there should be no yield on reserves anymore. I think they'd like to throw the cat amongst the pigeon and do that to the private banks in America and see what happens. But yeah, they will make the exchange. The danger actually for the banks was when interest rates were rising, because that undermines the value of long-term bonds. And this is what led to the collapse of Silicon Valley Bank. And this is another indicator that the people managing the Federal Reserve don't understand money, because when they put those rates up from down at the 1% level or lower, as they were in the lead up to COVID, going from 1% to 5%, if you had bonds which last as long as Donald Trump is talking about, like 100-year bonds, then that would reduce the value of a 100-year bond worth $1,000. If you cut from went from interest rate of 1% to 5%, you'd cut the value of that bond from $1,000 to a bit over $200, and then that's what that is causing all sorts of chaos on the banking sector. And the only thing that saved the banks from going bankrupt, because of the Reserve reversing direction of putting rates up rather than reducing, as they've been doing ever since the late 1980s. The only reason they avoided bankruptcy is because they pretend that some of their bonds are held to maturity. So they'll just record them at face value, and they don't record the change in the nominal value, because notionally they're not going to sell them. They've got others that they call mark to market. Now they would plunge in value. So the banks have to do all this shuffling between whether they record things as mark to market or hold to maturity. And if they didn't do that, if they had all of them mark to market, then quite possibly the increase in rates from 1% to 5% under Powell in the last 2 or 3 years could have bankrupted the American banking sector.
Because, take me through that step by step very quickly. So,
the bonds. You said the bonds and interest rates are inversely related, the longer the bond, the stronger that inverse relationship is. Yeah. So if your bonds were consols,
so the value of the bonds that they're getting. So yes, so you're saying the interest rate's going up, their bonds are worth less, and therefore
that's right, and that could have bankrupted the banking sector.
Yeah, okay, makes sense. So, but can they just hang on to them? I mean, if the yields fall, getting back to my point about the comparisons around the world. Yeah. The secondary market is going to be less interested in a very low yield country more than a high yield country, aren't they?
Yeah, the secondary market, and that will get your fluctuations and interest rate and exchange rate variations and so on. But none of that affects the capacity of the government to sell in the primary auction. Okay? The firepower they've got with the fact that the Reserve can just buy whatever it likes off any institution with an account with it, and that implies if you had bonds and you sold the bonds, that would go through the reserve account of your bank, and again the same thing would apply. The government could buy the lot. Its firepower means that it can make sure that primary auction gets covered.
So Scott Bessent has said, given that the interest rates or the yield on 30 years is so high now, why would they issue 30-year bonds right now? his point was we should really only issue 30-year bonds. Why tie ourselves in, lock ourselves into such a high interest rate right now? We should just be doing shorter duration. We really should only buy 30 years when the interest rates are lower. Has he got a point, or
But
is it another case of it really doesn't
thing
matter?
to do because the government is simply required by the laws passed by parliaments, not by the laws of accounting or the laws of physics, to issue bonds equivalent to the deficit plus interest on outstanding bonds. They've got complete choice in terms of the profile, the maturity profile of the bonds they issue. So if they wanted to, yeah, they could issue all 1-year bonds and cover the entire deficit that way. So there is a certain amount of intelligence in deciding what to offer given the current market conditions. But the government's not required to issue 30-year bonds. It could literally decide to issue none of them, and therefore the shorter the bond is, the less the change in the interest rate has an effect on its value.
Yeah. And there tends to be a correlation between 30-year bonds and mortgage rates. So so that could arguably bring mortgage rates down.
Yeah, and like when you look at what economists think they're doing by manipulating the interest rate, it's crazy nonsense based on the idea of rational expectations. And I could explain that in a forthcoming video as well. And that is not the main control of the rate of inflation. The main control of the rate of inflation is what happens with wage negotiations and payment and price of energy.
Yeah.
And so if you really wanted to control inflation, you'd be doing stuff on the labour market and the energy market. You would leave the interest rate fairly constant at the central bank, and that's what it was for decades before neoclassical economists got hold of the reins of power.
But that expectation, does drive bond prices and interest rates, doesn't it? Because you'll buy bonds at a particular, say, well, okay, I bought it at this price with this yield. I think it's going to be worth less. I'll get a higher yield, but I'm still going to be up ahead, or the other way around. You've got to go in with a plan about when you're going to get out. People don't hold bonds to maturity or very rarely, particularly government bonds. So there's that. People are gambling. It's just a big casino, isn't it? The whole bond market.
It's a big casino, and like I'd love to see them made less important and smaller. And just to make the political point. If the Fed buys all the bonds outstanding, the people who complain most about the disappearance of government debt will be the bankers.
Yeah. So there's one other factor here as well. So if we've got very high interest rates on government bonds, then there's the question about what that does to people buying corporate bonds. So, and that's where people start to look at the credit spread between government bonds and investment grade bonds. So that was around 180 basis points in 2022. So in other words, people would go, okay, I get 1.8% higher yield if I buy corporate bonds versus treasuries. So obviously corporate bonds are a bigger risk, but 1.8% is a pretty good return. That is now down to 100 basis points. So you get 1% more now. So there'd be less incentive with these higher interest rates to invest in non-government bonds, wouldn't they? And that is helping the real economy. That is companies saying we want to grow, we want to issue bonds. That's a real problem if people are saying, well, why would we bother with that? We can get government bonds over here, and you're not going to pay us that much more.
And that can reduce the rate of investment. Because like a huge part of investment is actually financed by short-term and long-term corporate debt. So if you have a higher rate for it, then one of the moderately correct elements of neoclassical economics there is a higher rate will mean less investment. But the main thing that affects investments are people's expectations of the future. And they are uncertain and volatile. And they're trying to fine-tune by fiddling with the one thing everybody can put into their calculator by not being able to control the thing that really matters, which is uncertainty about the future. It's a silly idea of how to manage the economy. A neoclassical economist made a stupid set of arguments that said the fiscal policy has no effect, completely wrong, and therefore they got the control of the interest rates and tried to do all of government policy by manipulating the interest rates as if that had fine-tuned the economy and bring about economic equilibrium. Well, have you seen that little duck walk along the screen in recent years? Equilibrium?
So it doesn't exist. But it strikes me that this is the biggest issue out of all of this. We've got higher government yields. It's forcing corporates to follow on that because they've got to pay big yields. So AAA rated corporate bonds have gone from about 4% in 2022 up to 5.4% now. So their cost of borrowing is going up and up and up,
yeah.
and that's the real problem. The other thing, just to finish with, the Mar-a-Lago Accord. I mean, what would happen if this was the government saying, okay, we've got all of this debt, let's just write it off. So anyone who's got short-term bonds, who's holding short-term bonds, we're going to swap it for a 100-year bond, and we're not going to pay any interest at all. So, and it would at all. It would be a non-tradable. It's basically writing it off. Non-tradable, non-transferable bonds that you are. So you're basically, if you hold $100 worth of bonds, you'll get $100 back in 100 years' time. So your grandkids will have, will get the money back, which will just be a very small fraction of what you were holding. But basically, you've just been written off. That would, talk about sovereign risk. That's a quick way of doing it, isn't it?
That is a pretty quick way of doing it. Another piece of madness I haven't caught up with the Trump administration.
Well, it's not happening, but it was
Yeah.
in there. The Mar-a-Lago Accord is one of many measures to try. Let's get rid of government debt by basically saying anyone who carries it has got to write it off. Madness.
Madmen in control. I think every day feels more like being on the deck of the Titanic, only it's too damn hot.
So it's cooled down a bit in the UK, I'm glad to say, when we're recording this. But so the upshot out of all of this, because we'll finish off now, but it is that extra debt coming in this bill is not the issue. It's, as always, it gets down to the question about who wins and who gains. It's the whole
redistribution, and it's always going up towards the top. Yeah.
Yeah. All right. And if we're concerned about governments having to pay high interest rates, well, maybe the Fed should buy. We haven't talked about, because that throws into the mix all of this as well. The Fed's, quantitative tightening, their belief that the bonds they hold, they need to be issuing back into the market. But if that wasn't such a focus, and it really was a concern that these numbers are muddying the balance sheets for the government, for the budgets for the government, the easiest way is actually just say, just the coupons just get paid for by the central bank.
Yeah, or you don't pay at all.
Yeah, but if you don't pay at all, what's the incentive for secondary markets or even for the banks?
The secondary market, you shut the secondary markets up, and that'd be a damn good idea, because the bond markets. Not that I just want to get rid of the nonsense that's said about government debt, and so the easiest way to point out that it's nonsense is buy the whole damn lot from the central bank and ask, can you do that with your debt? And then the question is, well, maybe government debt's not the same thing as private debt. We might start getting some intelligence in this conversation. Yeah, but outside you and me, of course.
Yeah, but you'd have such volatility in the finance markets, because you wouldn't have that. You wouldn't have those bonds
give them
which are keeping.
Weeks. Give them a couple of weeks, okay?
This sounds like a Donald Trump approach to me.
I've had everything else is happening. Why not do anything?
Let's break it and see what happens. All right, very good. Okay, well, hopefully people got at least half of that, and we'll catch you again next week. Thanks, Steve.
Okay, Matt. See you then. Bye.